All right, welcome to today's Explainer. If you're the kind of investor who just wants clear, unfiltered data to guide your portfolio, well, you're in the right place. Today, we're doing an executive briefing on Essential Properties Realty Trust, ticker symbol EPRT. We're going to bypass all the usual market noise and just look straight at the underlying metrics to see what the numbers are actually telling us.
Okay, right out of the gate, there's a massive data point here that practically demands our attention, and that is 75.86%. That's the calculated margin of safety for EPRT based on our source data. So how on earth do we get there? Well, the calculated fair value price sits at a staggering $129.50, but the stock's recent closing price? Just $31.26. Think of a margin of safety basically like finding a crisp dollar bill on sale for 25 cents. A gap that wide between market price and intrinsic value is absolutely wild, and honestly, it demands a deeper investigation.
To figure out if that massive discount actually holds water, here's our roadmap for today. We'll start with EPRT at a glance, compare its valuation against historical averages, and then examine revenue and income growth. Finally, we'll test its dividend reliability before we wrap it all up with an investment summary. Let's get right into it.
Okay, let's dive into Section 1, EPRT at a glance.
Here's your 10,000-foot view. EPRT is a solid mid-cap player with a market capitalization of right around $6.76 billion. As we just noted, it recently closed at $31.26 against that calculated fair value of $129.50. But here's the real kicker. Despite trading so far below fair value, it is not a falling knife. EPRT has actually posted a really solid 6.47% year-to-date return, which gives us an excellent, stable foundation to analyze its valuation multiples.
Moving right along to Section 2, Valuation versus Historical Averages.
We're going to use an anchor and adjust technique here, basically benchmarking current prices against the company's own norms. Let's start with the classic price-to-earnings, or PE ratio. Currently, EPRT sits at 24.61. Now, in isolation, yeah, that's just a number. But the context is absolutely crucial here. That figure sits a full 9.08% below its own 5-year historical average. Simply put, the market is currently pricing EPRT's earnings at a noticeable discount compared to the last half-decade.
And it is honestly fascinating to see how the price-to-sales ratio mirrors that exact same trend. The current PS ratio is 11.45, which is 8.45% under its historical 5-year norm. When multiple top-line and bottom-line valuation metrics point in the exact same direction like this, it builds a really compelling case for historical undervaluation.
Now, for the focused learners out there who love getting into the weeds, let's group these advanced metrics together. Think of enterprise value, or EV, kind of like evaluating the total price tag of a house, including taking over the mortgage, and comparing it to the rent it brings in. EV to EBIT, we're at 24.66, which is a hefty 13.3% discount to the 5-year average. EV to EBITDA sits at 17.29, nearly a 9.5% discount. These are undeniably cheaper than historical averages. However, to keep our analysis honest, take a look at the debt-to-equity ratio at 0.60. It's running about 4.34% higher than its 5-year average. It's not a red flag for sure, but a slight uptick in leverage is always worth keeping in your notes.
Okay, let's pivot to Section 3, Revenue and Income Growth.
So the pricing looks attractive relative to history, but we have to ask, is the underlying business actually expanding? Well, what jumps out immediately here is the sheer consistency of their top-line expansion. We're looking at the compound annual growth rate, or CAGR, for revenue. Over a 3-year period, revenue has grown at 25.30% annually. Zoom out to 5 years, and it's even higher at 28.11%. Guys, this isn't a one-off fluke. This is incredibly consistent, high 20s growth.
And translating that top-line success to the bottom line, the net income growth is equally, if not more, impressive. The data reveals a massive 42.66% 5-year net income growth rate. Now, over the more recent 3-year window, you'll see that growth has decelerated slightly to 19.44%. But let's keep our perspective here. A nearly 20% annual net income growth rate over 3 years for a real estate investment trust? That signals a fundamentally healthy, scaling business.
Which brings us to a really important point. The business is undeniably booming based on the top and bottom lines. But as an investor, you have to ask, are shareholders actually getting their cut of this growth?
That leads us perfectly into Section 4, Dividend Reliability. Let's see if that payout is safe. Right, so is the EPRT dividend actually reliable?
It's the high-stakes question every income investor needs answered before allocating capital. A high yield is completely meaningless if a payout cut is right around the corner, right? So let's let the data answer the reliability question.
The payout ratio is arguably the most comforting data point in today's briefing for an income investor. EPRT currently maintains a 60% payout ratio. That means for every dollar of applicable earnings, they pay out 60 cents to shareholders, leaving a very healthy 40% buffer retained within the company. This structural buffer strongly suggests the dividend is safe, it's well covered by earnings, and it's heavily insulated against short-term economic hiccups.
Building on that safety, the current dividend yield sits at a solid 3.97%. But what I really want to emphasize here is the consistency. Get this, EPRT has an 8-year streak of consecutive yearly dividend increases. And these aren't just token penny hikes to keep the streak alive. The 5-year compound annual growth rate of the dividend is 5.25%. That means you're getting a near 4% starting yield that historically grows faster than average inflation. That is a real game changer.
Let's bring it all home in Section 5, the investment summary.
Let's synthesize the hundreds of data points we've sifted through today into 3 actionable pillars. 1. EPRT is historically undervalued across multiple metrics, including PE, PS, and EV ratios. 2. The underlying business is generating phenomenal double-digit revenue and net income growth. And 3, they are translating that success directly to shareholders through a safe, well-covered dividend that has increased for 8 consecutive years.
Which leaves us with the ultimate question you have to answer for yourself. Armed with the knowledge of a staggering 75% calculated margin of safety, robust top-line growth, and 8 straight years of steady dividend hikes, does EPRT fit your specific portfolio strategy? I highly encourage you to take this baseline data, apply it to your own risk tolerance, and see if this real estate trust belongs in your lineup. Thank you so much for joining me for this explainer. Keep learning, and I'll catch you in the next one.